Every household in the country owes $280,000. This is essentially where the U.S. stands today, a record-breaking national debt of $37 trillion. We never thought we would reach this level so soon, but here we are. In this video, we'll explain how we reached this crisis point, what it means for your finances, and whether Donald Trump's plan can really resolve the situation. Stay tuned, because this affects every American, from their taxes to their jobs and savings. What is national debt and why? $37 trillion matters. The national debt is the total money the U.S. government owes. It's how much the federal government has borrowed over time to cover gaps when spending exceeds tax revenues. As of mid-2025, that number hit an unprecedented $37 trillion. For context, the Congressional Budget Office, CBO, had projected this wouldn't happen until after 2030. But pandemic relief bills, wars, and big tax cuts accelerated that timeline. This isn't just a distant budget number, it has real consequences. For example, rising interest costs. We're on track to spend about $1 trillion a year just on interest payments. That's tax money gone before paying for schools, roads, or health care. Put simply, higher debt can mean higher mortgage and loan rates for households, which is essentially what is happening in the country right now. Impact on your wallet. The government's own watchdog, GAO, explains that growing debt translates to higher borrowing costs for ordinary Americans. Think pricier car loans and mortgages plus lower wages as businesses shrink back, and even higher prices on goods and services. In short, a bigger debt burden can make everyday life more expensive for you and your family. It's a debt spiral, one tweet or bill away from hitting $1 trillion milestone. In fact, recent statements note we're adding $1 trillion more to the national debt every 5 months, more than twice as fast as the 25-year average. If that pace continues, in under a year, we'll easily hit $38 trillion. It's a juggernaut with no sign of slowing down. You may ask yourself, how did we get here? Well, the debt didn't skyrocket on its own. It's the result of massive deficits, annual losses, added up. In recent years, deficits have been huge. Congress approved sweeping COVID relief, expanded spending, and new tax cut bills. For instance, AP News reports that a mega Republicans' tax and spending package signed in 2025 will add roughly $4.1 trillion to the debt over the next decade. Pew Research Center adds that even before that law, the CBO projected the government would spend about $1.9 trillion more than it collects in the current fiscal year, meaning we're borrowing almost $2 trillion this year alone. Bottom line, every time Congress spends more than it taxes and never reverses the tax cuts fully, the deficit gets tacked onto the debt. Unexpected crises like the pandemic, military aids to Ukraine and Israel also forced heavy borrowing. The result? In just a few years, the U.S. debt climbed from about $28 trillion to $37 trillion, a jump of $9 trillion in roughly 5 years. It's no wonder experts say this was a moment no one in Washington can be proud of. What does this mean for Americans? The skyrocketing debt isn't just politicians' problem, it trickles down to everyone. As noted, the GAO spells it out. Rising government debt means you pay more. Imagine your mortgage or car loan interest rates creeping higher because the government is money left and right in the markets. Businesses might hold back on expansions or pay raises because the economy is strained, which can lower wage growth. Even everyday prices, groceries, gas, utilities, could edge up if the dollar's value weakens, a risk when debt climbs. In a nutshell, higher debt equals higher costs for regular people. On a household level, remember that every dollar of interest paid on the debt is a dollar taxpayers must earn just to pay off Uncle Sam's credit card. Committees warn that at current trends, interest alone could eat up $1 out of every 7 federal dollars. That squeezes budgets across the board, healthcare like we saw, with Medicare cuts, education, defense, which could force cuts or tax hikes later. So you might see higher taxes or fewer services down the road. Either way, you will feel it. You may ask how the government is dealing with the situation. Well, President Trump claims to have a fix. His administration's slogan, the One Big Beautiful Bill, touts tax cuts and deregulation to spur growth. For example, Trump's team says their plan would cut the debt to GDP ratio to 94% by 2034 versus 117% under current law. In campaign speeches, Trump insists his policies, tariffs on imports, tax relief, etc., will unleash growth to bring companies back and raise enough revenue to pay down debt. He even calls tariff the world's most beautiful word, betting huge import taxes will fatten the Treasury coffers. His recent actions echo this approach, launching Musk's Department of Government Efficiency, DOGE, to slash $2 trillion from spending, and pushing aggressive tariffs on China, Mexico, and EU trade partners to extract new revenue. He vows no cuts to popular programs like Social Security, Medicare, or Medicaid. As Reuters notes, the president explicitly refused to touch these popular benefits. Instead, Trump's camp argues tax cuts for businesses and workers will grow the economy enough to balance budgets. In one statement, he even suggested eliminating the federal debt ceiling altogether as the smartest thing Congress could do, meaning he wants to keep borrowing powers wide open. On the campaign trail, Trump has also criticized his opponents' spending. His spokeswoman recently blasted debt ceiling delays as foolish and inept and endorsed a short-term shutdown rather than accepting the latest spending bill with Democrats' giveaways. He and allies like Elon Musk pressure Congress to gut spending, insisting any move to raise the debt ceiling without cuts is unacceptable. Trump said that unleashing growth will shorten the debt, but independent analysts are skeptical. The Nonpartisan Committee for a Responsible Federal Budget, CRFB, ran the numbers and concluded that both 2024 candidates' plans would add to the debt rather than shrink it. In their central estimate, Trump's proposals actually add about $7.75 trillion to the debt by 2035. This is far more than the current path. In other words, experts project more borrowing, not less, under his platform. For comparison, even Joe Biden's proposed plans increase debt by about $3.95 trillion over the same period, which is half what Trump's proposal will add. So both sides are planning more spending than they cut. Even aside from tax cuts, some of Trump's ideas worry economists. For example, Reuters reported that some advisors floated radical schemes like forcing foreign holders of U.S. debt to swap in cheaper bonds or selling green cards for $5 million apiece. These out-of-box ideas may sound bold, but Wall Street analysts say they could spook investors and risk higher interest rates. Think of it this way. If foreign governments worry we're strong arming bond deals, they might dump treasuries, pushing yields and borrowing costs even higher. Some GOP voices, like Elon Musk or Representative Lauren Boebert, urge sweeping spending cuts and even a shutdown until debt rules change. The question that matters most is what choices American people have to make in the face of a debt that stands at $37 trillion and continues to rise. First will be taxes or cuts. Eventually, someone has to pay. Either future taxes will rise, or popular programs, education, pensions, healthcare, could face cuts to free up budget space. Trump says he'd rather grow out of it and demands other cuts, but he hasn't identified major entitlement cuts. If nothing changes, lawmakers will have to tackle it through higher taxes or reduced benefits to avoid a fiscal crisis. Interest rates. Impact. As debt grows, the risk premium on U.S. debt could rise, which means things like mortgages and student loans become more expensive. GAO warns your mortgage and car loan rates could creep up because of this debt. Watch for Federal Reserve moves too if inflation flares. Fed might hike rates, again making credit costlier for consumers. Second, inflation and currency. Large deficits can stoke inflation. Trump plans big tariffs, which could import inflation by making goods costlier. More debt could weaken the dollar's value over time, also raising prices at home. In practice, Americans might see grocery bills and gas prices higher if the debt keeps climbing without remedy. Third, global confidence. The U.S. is seen as the world's safest borrower, but even the AP warns that constant brinkmanship, like debt ceiling standoffs, could damage credit ratings or the dollar's strength. If investors lose faith, it could shrink U.S. influence and make borrowing cost more. For everyday people, this is indirect, but it ultimately affects jobs and investments. In a dramatic scenario, failure to control debt could lead to something like a credit rating downgrade. Moody's just downgraded the U.S. over rising debt. Or, worst case, a default on obligations. Thought unlikely. The result of those would be economic pain, recession, stock market drops, etc. Of course, no one expects default. Treasury insists we're never going to default. Still, the fear of debt crisis means even talking about the problem casts a shadow on the economy.